Yo, what's up guys? In this video, we're going to be going over 3 fantastic high-yielding dividend stocks that actually have room to raise their dividends. So in this video, I'm going to be doing some in-depth analysis so you can see how much money they make, how much does their dividend cost, how much room do they have to raise the dividend, and most of these are doing stock buybacks as well, so you now own more ownership in the company on top of the dividend yield. So we're just going to be getting into all the highlights. If you like this kind of stuff, don't forget to drop a like on the video. It'd really help me out a lot. But let me go ahead and get straight into the first dividend stock because this one's really impressive. I don't own this one and I've never talked about it on the channel, so let's get straight into it. All right, so for the first dividend stock, we have Kinder Morgan, and I want to show you 2 slides from their investor presentation. This is the most recent quarter, and I want to show you what exactly does Kinder Morgan do. So they actually have an irreplaceable infrastructure portfolio of natural gas and crude oil pipelines. I mean, look at this. We have some going from Texas all the way up to like New York. They have 9,500 miles of this, which is crazy, pretty essential. And on top of that, we can see they're BBB rated, so they have an investment grade balance sheet. They have a 3.9x net debt to adjusted EBITDA, which is very, very fair. And on top of that, this is huge. They're a very shareholder friendly company. 41% of the entire market cap value has been returned to shareholders since 2016. So this is a very shareholder-friendly company. They're dedicated to high dividends and stock buybacks. And on top of this, look at this. For the full year 2024, they expect 14% adjusted EPS growth and 8% plus adjusted EBITDA growth. So that's very inflation beating. So that's awesome. So now let me show you their numbers. So Kinder Morgan actually has a pretty big market cap of $46 billion. So this is a pretty big company. They have a dividend yield of 5.47%. And on top of that, they have a forward PE ratio of 17.08. So from a valuation point of view, even at all-time highs, they're at a very attractive valuation and still have a very attractive dividend yield. And for these kind of natural gas pipeline stocks, we want to look at their free cash flow per share. And check this out. It was 76 cents in the most recent quarter. So how much does their dividend cost every single quarter? Literally only 28 cents, and they have a good history of growing it. They're only slowly growing their dividend because they already have such a high yield. But look at this. In 2017, it was 12 cents. Now it's nearly 30 cents, which is pretty cool. So look at this. They made 76 cents, which can afford nearly 3/4 of the entire dividend. So let me visualize that from a cash flow point of view. So yeah, look at this. They haven't done any acquisitions. So look, they have the same amount of assets right here. See, same assets from 1 year ago, and they're still growing their free cash flow. So let's take this bad quarter down here. Look. 2 quarters ago, they only made $1.19 billion. So let's not give them the benefit of the doubt. $1.19 billion, and their dividend literally only cost $641 million. So that's what I'm saying. This company actually has some room to raise their dividend. And on top of that, look at this. If we go to their total common shares outstanding, you now actually own, it's not much, but 0.43% more of the company than you did 1 year ago, thanks to them doing stock buybacks. So yeah, this company is very financially stable. It reminds me of ticker symbol EPD. This is another high-yielding natural gas pipeline stock. I would be careful though, because this stock might give you a K1 tax form. I'm not sure if this is an MLP. It might not be an MLP, but let me know in the comments if this is an MLP. All right, guys, for the next fantastic high-yielding dividend stock, we have ticker symbol MAA, or Mid-American Apartments, and they are a REIT, a real estate investment trust that focuses on apartment units, and they have 102,000 apartment units, and I really want to own this company for how credible they are. So this is super impressive. Check this out. They are a member of the S&P 500, and they're also A-rated from Moody's and S&P Global. And on top of that, they're very financially safe. Their net debt to adjusted EBITDA is 3.6. Realty income is closer to a 5, but also realty income has more predictable income with their triple net lease REITs. But anyway, let's keep going here. This is what's really impressive about the company. The core FFO per share growth. So this includes any acquisitions or stock-based comp that they have on the mid-range of guidance for the full year 2024. They have $8.88 of core FFO. And look at this, the annual dividend cost $5.88. So they have a very safe and healthy dividend payout ratio. And check this out. I also want to do a multiple on this. So remember, $8.88. What's a fair multiple? Like a 19? That's a $168 stock price. And right now, MAA is trading at $153 per share. So in my opinion, there could be some room for the stock to appreciate in stock as well as grow their dividend. I mean, the core FFO can definitely afford that. And I also want to show you their geographical diversification real quick, last slide. So most of their revenue actually comes from mid-America, like they said, from the Sun Belt area. So 12% from Atlanta, Georgia, 10% Dallas, Texas, and then we actually have more Texas. So Texas is a huge chunk of their portfolio. We have 2 Floridas here. So yeah, really down south where there's a lot of sun. And we can, this is super impressive that they have these stats. We can see the average new resident income. So if you're a real estate guy, all these numbers would probably really impress you. But anyway, now let's go ahead and get straight back into their numbers. I want to show you how much room they have to raise the dividend, because this is shocking for a REIT. They actually have so much room to raise their dividend. All right, so here's ticker symbol MAA. They have a market cap of $18 billion, and they have a dividend yield right now of 3.84%. And why that yield might not seem super high right now, I'm going to show you how much room they have to raise it. So remember, every single quarter, their dividend costs them $1.47. And look at this dividend growth. I mean, literally in 2020, it was just $1. Now it's $1.47. So they've risen their dividend by 47% since 2020. But anyway, point being, remember that their dividend cost $1.47 a quarter. Here's the number we want to look at. This is the core FFO per quarter. And look, in the most recent quarter, they made $3. So that just the most recent quarter can afford 2 quarters of dividends. And even if we look at that bad quarter, look, they made $1.71, which was a bad quarter. They could still afford the dividend on that. And check this out. That's with the same amount of assets, so they're organically growing. So look at this. We'll actually visualize a number for you. So look at this bad quarter of $200 million right there. We're going to not give them the benefit of the doubt. Remember, $200 million, and their dividend cost $172 million. And for a REIT, a real estate investment trust, that's a super safe payout ratio. And we're looking at the bad numbers. And on top of that, if we go to the diluted weighted average shares, you have not been diluted, only 0.05%, which is literally nothing. So that's what I love about the company. But I'm really considering picking up shares of MAA because I own another REIT here in my Robinhood portfolio. I own some Realty Income. We're actually up 15% on our shares, which is pretty cool, not including the monthly dividends we've been receiving. So these 30 shares that I have give me $7.89 every single month, which is pretty cool. But enough about the REITs. Let's go ahead and get into the final fantastic high-yielding dividend stock. All right, guys, the last fantastic high-yielding dividend stock, we have ticker symbol ARCC, or Ares Capital, which is actually benefiting from the reduction in number of U.S. banks over time. What they do is they do lending, specialty lending, and let me show you what most of their loans are like. So first lien senior secured loans, so that means if whoever they're loaning the money to, if they go down, whenever they sell their assets, the first money goes to Ares Capital. So having first lien and second lien loans is the priority thing. Is very, very good. They also have some preferred equity in some companies. So, kind of like how Warren Buffett has preferred equity in Bank of America, but we can also see the diversification. And here's what's super impressive about these lenders. So ARCC's loss rate are considerably below industry averages. So ARCC is less than 0.05% on the first lien loan and less than 0.1% on the second lien loan. And I'm not sure if this is cherry picked, but they claim that the ARCC's total shareholder return is well above the S&P 500 index when you go out like on this far scale. So check this out. I mean, you can't make that up. Look at ARCC. They can't lie in these investor presentations, but they can suit it up. But I mean, check that out. I mean, it really has especially outperformed the S&P 500 BDC index, which is, what their competitors are. So obviously they have credit rating from Moody's, S&P Global, and Fitch, which is pretty cool. But anyway, let's dig straight into their numbers because that's what's awesome. All right, so here's ARCC. They have a market cap of $13 billion right now. And check this out. Even at close to all-time highs, they still have a dividend yield of 9.33%. So this is the highest yielder on the list. And on top of that, look at the forward PE ratio. It's an 8.83. And for these BDCs, I think the proper metric to look at is the EPS, which is net income, because this company is cranking out net income. I mean, look at this. Look at the most recent quarter. It is down, but remember that $322 million. And remember, this company has to pay out most of their dividends by law. They're very similar to REITs, but this is a BDC. But look at this. Their dividend costs $280 million a quarter. So very sustainable based off this net income, assuming no growth. They don't even have to grow their net income. Look, 3 quarters ago, they made $500 million just in 1 quarter, which is crazy. And they're also growing their top line, their total revenue. It's up 19% year over year. So yeah, I guess the loan business is really doing good right now. But yeah, hope you guys really enjoyed this video. And if you did, don't forget to drop a like on the video for me. It really helped me out a lot. And if you leave a comment, I'll respond to every single one of them. But yeah,